video solution walkthrough for Kiso, Weingarten, and Warfield. This is exercise 1425. This, I believe, is take 2 or 3. This textbook, the authors are Don Kiso, Jerry Weingarten, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 and 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or Wiley. Okay, so let's take a look over here at exercise 1425. So I'll painfully get rid of the work I already done. This is my second take on this question. As you can tell, I'm pretty excited about that. So we have a situation with gym, tanning, and laundry. No, not that situation. We have now American Bank loaned money to Barclay. And when it loaned money to Barclay, they essentially decided to restructure the note. When they restructure the note, at least for exercise 1420 through 23, that example, it went from 3 million to 2.4 million. And the interest rate went down from 12% to 10%. So in this situation, what's happening is that it's now going down. It's not 2.4 million, it's 1.9 million. And the interest rate is going to be at 10%. So to figure out the loss that they're going to be recording on the books, what we need to do is we need to look at the carrying value of the note receivable. And what we have to do is we have to compare this to our cash flow payments. So what are we going to be receiving in the future? Well, on 1/1/24, we're going to be getting 1.9 million. Right, so we're going to get 1.9 million. And what else are we going to be receiving? Well, on 12/31/21, we're going to get an interest payment from Barclay of 1.9 million times 10%. On 12/31/22, we're also going to be getting an interest payment of 190,000. But on 1/1/24, under the modification, the principal payment is going to be 1.9 million. Okay, so those are going to be the cash payments we're going to be receiving. Now, $1 today is not the same as $1 tomorrow. So what we have to go through and do is we have to discount these future dollars back into today's dollars, find out what this note is worth, and then we're going to figure out what our loss is going to be. So right over here, when we're looking at the carrying value of the note receivable, what is it? It's 3 million. But what is the present value of my future cash flow payments? So for this 1.9 million, this is being paid to me 3 years from now. So in order to bring that back to today's dollars, I'm going to have a present value of $1, 3 periods at 12%. So 3 periods at 12%, I'm just going to go ahead and borrow from over here, and I get 0.71178. Again, where did that number come from? 3 periods, 12%, 0.71178. Present value of $1 is used for lump sum payments, annuity, same payments year over year. So the present value of the principal is going to be 1.9 million times 0.71178. I then take the interest payments. For that, I will need to go, my interest payments are going to be 190,000. I'm getting 3 of them. This is going to be a present value of an ordinary annuity of $1. This is going to be 3 periods at 12%. So right over here, this is going to be, let's see, so this will be 3. This is going to be 2.40183. And if you don't believe me, actually I screwed this one up on the last question, but right over here, 12%, 3 periods, 12%, 2.40183. I use this table because the payments are the same every period. Okay, so the present value of the interest payments. is 456,348. So my total present value is going to be 1,808,730. So this is what the value of the notes is worth. However, the amount of the face value is 3 million. So my loss or bad debt expense is going to be 3 million minus 1,808 or 1,191,270. Now, if I look at this over here, and I've got over here, so I've got a note receivable here. My note receivable is on my books at 3 million, but how am I going to go down and bring this down to 1.8 million? What I'm going to do is I'm going to essentially use an allowance for doubtful accounts. My allowance for doubtful accounts is essentially going to be showing here 1,191,270. So my carrying value of the note receivable is going to be 1,808. So how do I record this allowance for doubtful accounts? Well, on 12/31/20, I'm going to have bad debt expense for 1,191. I'm going to credit allowance for doubtful accounts right over here. So that's what I'm going through and doing initially. Now, and in terms of going through and doing the payments, right? So over here, I've got 3 interest payments. How is this going to go ahead and work? Well, I know that my interest expense or my cash received for interest is going to be on 12/31/21, 12/31/22, and 12/31/23. It's going to be 190,000 each of those years. The amount of the interest revenue and the interest rate I'm going to be using is the one I use to go through and discount those dollars back. But to figure out the interest revenue, I need to figure out the carrying value of the note receivable. So the carrying value of the note receivable is how much? Well, that carrying value of the note receivable on 12/31/20 is the note receivable minus my allowance for doubtful accounts, or 1,808. So my interest revenue is going to be 12% times 1,808, or 217.48. So that's where that number is coming from. Now, the difference is going to be my allowance adjustment, or my ADA, allowance for doubtful accounts adjustment. And this is going to be over here is 27,048. So this is really to kind of reflect that additional interest expense. Remember that this is being done at 10%, but I'm using a 12% interest rate. So that's where I see this over here. So when I debit this, or when I record this, my new carrying value is going to be 1,835,777. If you think about this from a journal entry perspective, on 12/31/21, I'm going to be debiting cash for the amount of cash that I'm receiving. I'm going to be debiting the allowance for doubtful accounts for 27,048, and I'm going to be crediting interest revenue for 217.48. And that's what I do over here. So this allowance for doubtful accounts, first entry over here is 27,048. Let's go do the next period. My interest revenue is going to be my carrying value times 12%. So over here, my adjustment is going to be the difference between my interest revenue and then my cash received for interest, or 30,293. So this over here So over here, cash paid for interest, this is always going to be the same year after year. My adjustment for my allowance for doubtful accounts is $30,293. My interest revenue is $220,293. So my carrying value, again, this is getting written up. This is going to be $1,835,000 plus the $30,293. Okay, so in the last year, my interest revenue is going to be my carrying value times 12%, or excuse me, is going to be, where did I screw this one up? This is going to be my carrying value of my note times 12%, or $223,928. So my allowance for doubtful accounts adjustment is going to be the difference between the difference between the amount of interest revenue and the cash received for interest. So my carrying value is now $1,899,999. Now this is very important because it has to equal, this final carrying value needs to equal the amount I just adjusted this. This needs to equal the amount that I'm going to be receiving on January 1st, 2024. So just going through over here and finishing this, and that's how we get it. Okay, so my allowance for doubtful accounts made an adjustment over here of $33,929. And let's just take a look at this really quickly. So after I've gone through and I've made these various different adjustments into my allowance for doubtful accounts, my ending balance here, my allowance for doubtful accounts is $1,100,000. So now that I'm actually going through and receiving the cash for the note on 1/1/24, I'm receiving 1.9 million because that's how much I'm getting paid from basically from Barclay. The thing I now have to do, though, is that once they pay it, I've got to get rid of this note receivable off of my books. So I'm going to do that over here by crediting it for 3 million. My entry does not balance. What does the remaining balance have to go to? It's going to be going over here to my allowance for doubtful accounts of 1.1 million. Once I hit this, it's pretty much done once I debit this over here for 1.1 million, and now the loan's been settled, this should actually have the amount of the allowance account should essentially go down to zero, which is, that's what it should be because the loan is no longer outstanding. And I was just using this as a way for valuing the account. So that is exercise 1325. Hope you enjoyed it as much as I did. And let's just go ahead and record receipt of loan. Okay, was there anything else I forgot? Let's take a look. What entry should they make on January 1st, 2024? That's it right here. Prepare the interest receipt entry for American Bank. So we've done those. Interest receipt schedule, and there you go. So this one is probably going to be a little bit easier to use the Ingrid rule of doing T accounts. In any event, I want to thank all of you for joining me here today. I want to thank Wiley. Please don't forget to like and subscribe. If you want to see solutions for other videos, please feel free to ask me in the comments. Have a great day, and I look forward to seeing you on the next video. Have a good one.